Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for checking in for another episode of Zen and the Art of Real Estate Investing. My guest this episode is Justin Goodin of Goodin Development. Now, Justin's story started with a $44,000 renovated home buy in Indianapolis, and now it's multifamily development for busy professionals. So we are going to talk syndications, but we go through the backstory. Let's go. This is episode 207 of Zen and the Art of Real Estate Investing with my guest, Justin Goodin. Justin is the founder of Goodin Development. They build premium market rate communities throughout Indiana and help busy professionals invest in real estate without the hassle of having to analyze properties, manage tenants, or deal with any repairs. Justin, welcome to the show.
Have me on, Jonathan.
Yeah. I'm always excited to talk syndications and multifamily, but also the story. But I don't know if you know this, my listeners probably do, but I only got started in syndications last year, and now I'm a little bit obsessed. So I really do like talking about syndications, and I like it as an option for newer investors now. So that's something I'd like to get to. But how did you get started? I think it was on a $44,000 home. That was your first buy?
Correct. I mean, at the time, I was going down the traditional path, like most people. I mean, going to college, getting a job, investing in a 401k, buying a house, going like the whole traditional path. But yeah, to answer your question, my first taste of real estate came from buying a single family house on the west side of Indianapolis for $44,000. This is back in 2017, I believe. So yes, houses were that cheap back then. And this was a recently renovated flip, if you can believe that, for $44,000.
Wow.
So that was my first kind of taste in the real estate. At the time, I knew nothing about apartment investing, raising capital, or partnering with people to, take down some of these larger deals. So again, like most people, when I wanted to get into real estate, the first thing that I thought of, okay, I'll go buy a fix and flip or a rental, which is like all I knew at the time. So went down that path of buying rentals, doing fix and flips. After graduation, my first job was actually working for a bank as a multifamily underwriter, which was, like fantastic experience for like what I do now, kind of seeing how banks underwrite deals, how they evaluate sponsors. So all this sort of, formulated me into going full-time into real estate, really like opened my eyes to the benefits of commercial real estate, apartment investing, raising capital to scale your business. All those things like really propelled me to go into real estate full-time.
Yeah, back on that first deal, what led you to buy real estate, though? Was it something you were always interested in, or was it just like, hey, this is $44K, this can't be a bad investment, and it's also renovated, which sounds crazy to me?
Yes, it did. But yeah, at the time, I wanted passive income. I wanted to do things to generate income on the side. And I'd already been doing like some swing trading and day trading, if you've ever done things like that.
Yeah.
Lost a lot of money doing it, wasn't good at it, it wasn't passive. And so I've always heard that real estate was just an awesome way to generate passive income, build wealth. And that's like what, drew me into kind of like that world and getting started with the rental.
Yeah. Is that why you bought something that was renovated? You didn't want to go in and not knowing anything, try to do a rehab or a burr or a fix and flip, which I think is really smart.
Exactly. Yeah. At the time, I didn't even know about the burr strategy. So my thinking at the time was, like really just buy a, good looking property, something that I wouldn't have to dump a lot of money into, and something that I could just buy, hold on to, and collect cash flow every month. So while I think it was a good stepping stone, it wasn't giving me the passive income that I had thought or hoped it would. Contrary to what you see on the TV shows or hear about on social media, I mean, buying rentals is not passive. I was self-managing it. I was, calling contractors to do the repairs, but it was still
Yeah.
a lot of time and hassle. Had to deal with evictions a number of times. Had to actually take off work sometimes to go to an eviction court. So yeah, like one of the many reasons why I started looking into commercial real estate and apartment investing, the rentals were a good stepping stone, but not something I wanted to do long term.
Yeah, I think that's what a lot of people get to. It is a great thing to learn, like, hey, this isn't what I thought it was going to be. I don't think really almost nothing is passive except for really syndications, which of course we'll get
Exactly.
to. And that's where I think it's interesting to see your scale, because you really learn. I think a lot of people, like you said, they get a property on the side. They're like, this is going to be great. And then you're with your family on the weekend and somebody calls with a plumbing problem. And you're like, well, I'm at Great Adventure or something. Like, this sucks. So it is an awakening, but also a great, and that's a really low input to be able to buy a single family for 44K and get some income. I mean, you're definitely going to be positive on that. So how many properties did you buy before you were like, no, this isn't the thing for me. I'd like to go bigger.
It was a handful. It wasn't very many. It was a handful of flips and some rentals. Have since, sold and stopped doing the
Yeah.
rentals and sold the fix and flips. But yeah, a handful of properties like that and moved into larger scale commercial multifamily.
Yeah, and I guess based with your job, you had so much access to underwriting that it probably started to make more and more sense. Like, wait, I can just do this, but more, and I know more. Is that what happened?
Yeah, exactly. So, I mean, working as an underwriter, you get to see everything. You get to see the borrower's tax returns of how they're
Yeah.
paying, $0 in taxes from owning real estate. You get to see their balance sheets, their income statements. You get to see the income these larger properties are producing. So, I mean, yeah, it's sort of like a behind the scenes look at commercial real estate, at the benefits of apartment investing, which, yeah, sort of like propelled me into going into that world even more.
Yeah, I've heard that actually from CPAs who, before they started investing, they're like, "Well, I'm looking at these guys' tax returns, or ladies, or people, and they're
Yeah.
crushing it. Like, why aren't I doing this?" You really had the back end to say, like, "Wow, I'm going to help this person get a loan, but like, I could take down this property. Maybe if I grabbed a couple people." Was it interesting to see the back end comparing commercial underwriting to just residential, which isn't really underwriting; it's like a sniff test.
Yeah, totally different ball game. Yeah, in a number of ways, for sure.
Do you think the experience though with those handful of single families helped you though with the on-site due diligence when you got to multifamily and when you started to want to do syndications? Because obviously, like, you have to know about houses, or else you only can rely on other people.
Could be some similarities in there. If I was like really involved with the construction work or the renovating, which I was not. So for me, I don't think it like really helped a ton. And quite frankly, I just think like once you go into commercial real estate, apartment investing, I just think it's a totally different ball game. I mean, there's so many other variables and factors you have to look into.
Yeah.
So yeah, I mean, single family can be a good stepping stone, but I don't think like all that experience like really translate over into commercial real estate.
Yeah, that fair point. It's obviously larger scale, and you on commercial, you really should be relying on experts more than yourself. Because if you've only had
Exactly.
6 single families, you can't walk into an 80 unit and think like, I got this.
Exactly.
I've got this covered here. It'll be fine. Because then you have much more risk on the table. Obviously, the deals are getting larger. When you decided to go bigger, when you got rid of the other ones, what was the first multifamily deal that you went into? Did you buy it yourself, or did you immediately think, hey, syndications are something that are going to work based on the price points that I want to acquire?
Yeah. So yeah, at the time I was looking around my hometown for different commercial real estate or commercial apartments to buy. This is in Indianapolis, Indiana. And I was doing like a number of different things to try and find deals, from talking to brokers to cold calling to sending out mailers. And I came across my first deal from sending out a direct mail campaign to owners here in Indianapolis. So this was a 29 unit on the west side of Indianapolis that me and another general partner purchased, raised the capital from limited partners. And that was like my first taste in the syndications and the first deal.
Wow. Okay, great. 29 units it's a pretty solid number to take on for the first one. Not too big though, like definitely manageable. What was the general price point of that? And then how many investors did you bring in? Because I think when you do your first one, I want to talk about it because it's the first time you're raising money. It's a little bit different.
So this was 29 units. We purchased for 1.36 million.
Yeah.
and put about $500,000 into it for capital expenditures. And I think we raised around $500,000 as well. Limited partners, I think we had around 8 or 9 investors in there. And
Yeah.
yeah, one other general partner, and we both, fully asset managed the deal and accomplished a business plan on it. So yeah, actually, 29 units we later turned into 33 units with renovations and adding units. But this was your classic, value add deal. This was a property that was owned by this particular gentleman for over 16 years. He
Yeah.
lived on site in one of the units, drastically under market rents, outdated units. A lot of the qualities of your kind of like perfect and prime value add
Yeah.
deal that everybody's looking for.
Yeah, everybody's crying right now because they can't find those deals. But it's interesting to see because what you did to find it is something that anybody could do right now. Even if you're new, you can find it. Were you mailing smaller lists? Because to me, like when I was trying to mail self storage, I was really curating the lists tighter because obviously there's not that many. I was looking for just mom and pops. This, like you said, best owner you can find, mom and pop owner living on site. You literally can't do any better. Under market rents, traditional, probably needs some upkeep, but he's just tired. They're tired of doing it. They want to pass it along to someone else. What type of lists were you making? And were you making those smaller to make sure you had at least a better chance of hitting one?
Yeah, a couple of things about the list. I think if you're contacting owners directly and creating this list of potential owners, I think you should definitely take more of like a sniper approach to your list and
Me
not so
too.
much like a shotgun approach. Reason being is like you're gonna spend time and money contacting these owners. When somebody does contact you, you want that owner or have a property that's exactly your criteria
Yeah.
and something you want to buy. So yeah, my list was very narrowed. I don't know the exact list, but I think it was around properties between 20 and 50 units, built in like the 1970s, things like that, and longer term ownership.
Yeah, so smart. I think that a lot of people make mistakes list building, and you had already bought single family homes. But if you want to acquire multis and you're getting started, the best way is to build really tight lists, like you said. So it's your buy box. Don't go too crazy. Just pick what you want. And the ownership thing is the most important there. If you're picking, 10 years or more owned when you're doing single families, okay, that's like half the block in suburbia. That's not a big deal. You go
Yeah.
30 years for that. But for commercial, you can really go 10 years and up. And when you're looking at 15 years, 20 years for commercial, and then again, if you see they live on site, you're like, well, this is a home run. That's a great tip off as well. Were there any other things that you were looking for in terms of the upkeep? Did you want to do value add, or were you just thinking like, if we get something in this, we'll assess it based on the numbers?
Yeah, I wanted to do value add. I was looking for a property that, intentionally needed some, fix upping and, be able to renovate it, add value to it. Basically like a fix and flip for an apartment complex.
Yeah.
So, when I first toured this property, I just knew it was going to be an awesome deal. Pending we got it at the right price, which I feel like we did, but gravel parking lot, like I mentioned, just outdated units. There was like unused space along this area of the building. There was walls and windows, but actually just like nothing that the space was being used for, which is how we added 4 more units to the building and drastically increased the value of that. Yeah, so just a number of different things like that kind of just screamed as an awesome value add deal and a really good investment for my first one.
Yeah, and you must have found out the key that obviously as you go into larger deals now. When you're in larger deals and you're doing these small modifications, you're like, oh, we built 4 units. That's a gigantic uptick in value, just like getting the rents up $100 across the board. The more units, the more value add. If you have 100 unit and you can get up an average of 100, you just increase the value like $1 million. Like it's kind of crazy the way you think at it. And is that part of the reason that you saw the difference? Like, well, I could do this with single families, but the work that I do only applies to 1, whereas the work here applies to 29 and then 33 units across the scale.
Yeah, exactly. One of my key decisions for going into multifamily or commercial multifamily is that, these assets are treated just like businesses. They're valued just like businesses. So the more income this property is producing, the more it is inherently worth or value. Unlike single family houses where you could dump a bunch of money into it, renovate it, fix it up, the value is still going to be determined by the comps in the area.
Yeah.
Commercial multifamily, you could have 2 of the exact same properties next to each other, if one is producing more income than the other, I mean, that one is automatically worth more. So that's a, key distinction in commercial multifamily. But the more you can, force depreciation, increase the rents, increase the value, I mean, you are making that property worth inherently more.
Yeah, that's a great point. And I think people forget that when you're talking about single families, even if you have a nice rental portfolio of 10 single families, say you get two that are people are just paying wildly great rents, that doesn't mean it's going to appraise at the price per rent. The appraisal is based on comps, like you said. And when you get to 5 and up multifamily, you're dealing, like you said, with a business. And I think that's really smart to look at. And one of the coolest things about multifamily is you're really buying a business that operates on top of real estate. You get the land, you get the amenities of it, you get the options of upgrading the units, like you said, but then you also get the business that's running. And part of what you can do with value add is also in the operations part, right? I mean, you take over for a mom and pop, sometimes they're like literally have it on a piece of paper, the rent roll. And so that's hard for the tenants. Did you start to do that as well as you got through this? Like you're going to operationalize it more so it's easier for the tenants so they have a better experience?
Of course. I mean, yeah, it was a combination of increasing the income by, adding value and making the units look nicer and more modern. It was decreasing expenses. It was decreasing utility amounts. And I mean, yeah, most of all, it was implementing a professional property management company, which I think just drastically, turned the entire property around. But yeah, there's a professional manager there, professional people taking care of the property. So night and day difference from what it used to be.
Yeah, so we'll get to more of your investments. For that first one, obviously, you hired out professional property management in the area, right? You guys weren't going to do it yourself. How easy was that to figure out? Were you doing it based on people you may have used before, or were you looking for something different as you got up to 29 units? Because that's a different company sometimes.
Yeah, at the time, we used a manager that we had already had a relationship with, ended up switching managers down the road. But yeah, just kind of going back to people we had in our network and went with them for the manager company.
Yeah. Excellent. All right. So after that 29 that you turned into 33, did you kind of get a proof of concept and say, I guess we can go bigger? It was cool, though, that you mentioned, because I wanted to get out the amount of investors, because I think that it's important for people to say, like, if you start in syndications, you don't need to do a $15 million deal. You had basically 8 investors, including you two, right? Yeah, that's a manageable thing. So just before we get to how you got bigger, what was it like asking for money for the first time? Were you well versed in it, or was it something that you guys had to kind of workshop, or was the asset just so good you knew like people are going to get this? It's great.
Yeah, I mean, it was an awesome investment and still is today that we still have. But yeah, at the time, I knew nothing about raising capital or talking to investors. I really kind of just used my experience in other parts of life to kind of communicate why I thought this was an awesome deal, why they should trust me most of all, and why I, thought it'd be a good idea for these people to partner with me. So yeah, it was my first deal, but I kind of just leverage the experience that I had in other aspects of life. I had another experienced partner on the general partnership that kind of helped with that credibility as well. He had experience in apartment investing before me. So a combination of those things, but ultimately kind of just giving your investors a reason to trust and invest with you.
Yeah, now I think that's even, I mean, it always should have been relevant, but it's even more relevant now because obviously they're in the syndication area. There were some blips for some people over the time frame. So how do you develop the trust now? Is it just the product and your track record of doing business? Because there are a lot of shiny objects out there that people can see in the syndication world that really look pretty good. How can we help people who are looking to get into syndications figure out like, hey, who should I trust out there? Who's a good person? How do I know what to do?
Yeah, a few different things. And there's some really simple things that you can do to, evaluate these sponsors before you work with them. I mean, one, I think that is the most easiest, pretty simple to do, is just run a background check. Run a background check, which is pretty simple to do, and find out things that may be on that file. You can ask them about it. If they're willing to lie about things that happened in the past, or maybe lie about an educational degree, you definitely don't want to invest with them and, know what they're going to do with your money. Other than that, I mean, you can ask around. I mean, commercial real estate is surprisingly a very small community. So
I agree.
Ask around, talk to other investors, talk to other potential people that they may know, and just, ask about their credibility, their background, and, what they know about that sponsor. And most of all, I think you should always just, ask about the current deals they have in their portfolio. I mean, it's really easy to post all the good things on social media and for sponsors to not talk about things that are going on behind the scenes. But I mean, ask about current deals they have in their portfolio, ask how those deals are performing compared to their original underwriting projections, ask about capital calls and things like that.
Yeah.
But, just sort of like get behind the scenes and ask about things that sort of like on your mind.
Yeah, I found that in getting into it, the best syndicators always have an answer. It's not always the best answer that you want. It's a realistic answer, so it's being transparent. But anytime if you're asked 7 questions and 5 they need to get back to you, that's not good. They don't
Exactly.
know their own data on the back end. So as you guys scaled up from 29 and started going into other projects, what have you ended up on a number in terms of units that you're looking for now? Do you have an ideal buy box on units now? I'm sure it's changed from the beginning.
Yeah, so now I'm 100% focused on ground up multifamily development. We are looking to develop between 50 and 150 units here in Indiana. I'm a huge fan of just staying laser focused on one thing. So when I pivoted to development, and a number of reasons for that, I'm just looking to do only development, only here in Indiana, and only just Class A mixed use properties.
Yeah. That's awesome. I think having the tight buy box is what everybody says, riches in the niches, but it just makes you focus so that you can say, like, we know this asset class. So when you're going to do it for the investors who are coming in, they're like, well, they have 3 exits at this. This is the wheelhouse. I think that makes it a little bit easier. 50 to 150 is interesting to me though, because somewhere in there is the break for on-site management. So is it really like what land's available and what product is going to work on the land? Or are you thinking in terms of like on-site management, off-site in that context?
Well, I think there's a lot less competition in that space, which I think will in return allow my company to develop more product and do more volume. So, the management company is definitely a smart thing to think about. For me, we are not looking to hold on to our properties. We are looking to build, lease up, and immediately sell. So, I definitely take that into account. But we've been, successful at it in the past with smaller size properties. But for us, we just have a business plan of building, leasing up, and selling. But to answer your question, there's less competition sort of in that space. And there's like maybe like only a handful of developers, at least that I know in Indiana, that are doing deals or able to do deals in that size range.
Yeah, because your exit buyer is different also. You're not selling to, hedge funds at 35, 50 units. You're usually going to sell to another investor who wants to buy bigger, probably a 1031 exchange a lot of the time from something else, because the hedge funds want to buy bigger, 200 units, 300 units and buy it in. So that's really interesting too. But that's important note though for investors. When you're doing development, of course, investors are going to need to wait on the cash flow. It's a more wait and see on development, right? For the people who are hopping in on that type of syndication.
The investors that we're typically working with are just people who are looking to, really just like multiply their equity as quickly as possible. And as you know, especially right now with how interest rates are, with how competitive the market still is, I see deals at cash flow, like maybe 4%, 5%, maybe 6% a year if you find like a really good deal. But usually like when I talk to investors, that 4 or 5% coupon is not like really going to be life changing to them. But they could potentially double or near double their investment in 3-4 years. That's pretty meaningful to them. So a lot of our investors are more concerned about just multiplying their equity as quickly as possible.
Yeah. I think I've found a lot of people pivoting just to their own builds and development if that's going to become their wheelhouse, just because you're going to get a lot of benefits. Your insurance costs are going to be better. You have full control over the product. You don't have to fix something that somebody else did. You buy 70s or obviously before, it could look good, but more stuff's going to come up. And you obviously have builder warranties and also grants that you can get from the city that can assist in building. Am I right on that?
Exactly correct.
Hey, it's Jonathan. I hope you're enjoying this episode with Justin Goodin, who is talking about Indianapolis. Do you know who else is from Indianapolis? The entire team of Deal Machine. Now, I've used Deal Machine for a number of years and I used it very successfully. And over the years, they've incorporated so many new upgrades that it's unbelievable. Skip tracing is baked into one of the upgraded platforms, so you can be driving by a house, do the data, get the skip trace, call, send a postcard from the app, all within a minute of that one that you know has high grass, a car, on blocks, and all the other things that we look for. So if you're interested in getting a free start on Deal Machine, you can go to my link at bit.ly/Zen Deal Machine. And that's bit.ly/Zen Deal Machine. Let's get back to Justin. Yeah, development is interesting to me. How many projects do you have? Are you just doing one at a time because it takes up so much? Or are you able to do multiple at a time depending on where you're finding land available to do this?
Able to do multiple deals at a time. I'm just like really focused on doing quality over quantity. So that could be one deal per year. It could be 4 deals per year. Really just, when we find an opportunity and it makes sense, quality over quantity is sort of my perspective.
Yeah, where does the land come from for these deals? Because I live in New Jersey. It's the densest state. There's literally houses or properties everywhere. There's not a lot of land that can just get picked up to do apartments, even though they find it in some areas or knocked down. Are you finding vacant land? Or are you knocking down like old motels or things like that?
A bit of both. Our first project, there was a kind of like a line of like 4 different single family houses on a road. And we're able to tear down these blighted houses and turn it into an apartment complex, a little over 3 acres in total. Our second one, similar. It was a really large piece of land, sort of like around this residential neighborhood, but just one single family house on that piece of land, just under 3 acres on that one.
Oh, wow.
So yeah, a combination of both. It could be a vacant piece of land. It could have something on it. So yeah, you're correct.
Yeah, and it's interesting because do you ever plan to go outside of Indianapolis? Like, do you see that as part of the trajectory? Hey, eventually we're going to grow. Like, maybe you still stay in Indiana, but maybe you can't stay in Indianapolis forever. I mean.
Yeah, I mean, at least like in the very like near term, next like 5 years, I'm not even thinking about that. Like only staying in Indiana for the very foreseeable future. A couple of different reasons. I mean, just living here in Indiana, I just like really feel comfortable with these markets here. I just know them. I'm comfortable with them. And, I like being within a few hours driving distance of my properties. So all my development projects, I'm there, a few times a week. And once you start going outside your state, it just becomes more difficult. That just comes into like you need a team, you need employees, still possible, just, different business plan. But for the foreseeable future, I'll be here in Indiana.
Yeah, and what's the general time frame for the turnaround? I know you said for the investors, they may get out 3-4 years. What's the build time usually like? If we just say, I don't know, let's just say 50 units.
14 months.
Oh, wow. That's pretty good.
Yeah, not bad.
Yeah, and then so 14 months it's build, you get it leased up, and then how much after that do you go to sell it? Like obviously you get it stabilized, you want to get your rent percentage at probably as high as possible, and then get it on the market or just sell to somebody that you already know is interested.
Could be like around 6 months after that, depending on how the market is, what's going on in the economy. Worst case, we would just hold on to the property until we could sell it for a better price if something did happen in the market. But yeah, like we have one that's about 70% complete right now as we're talking in November of 2024. We're expecting to start leasing this one up in March of 2025. And, like when we get closer to March, even slightly before that, we'll start shopping it around and talking to buyers around that time. But yeah, the sooner the better for us.
Yeah, and certainly they can kind of watch what's happening in terms of the rents and say like, okay, well, let us know when you have it 75% occupancy. If it matches your projections, we're in. And then you really have somebody kind of waiting on the sidelines there, right?
Yeah, exactly. And it's, really attractive for another buyer to come in and buy, basically a brand new property, fully leased up or in the process of leasing up. Less headaches with repair and maintenance, better quality tenants, market rents. Really attractive for another buyer to come in and purchase these brand new properties.
Yeah, I mean, it's like an ideal 1031 exchange, like I said before,
Yeah,
especially if somebody's like, leveraging out of something in California that could be like 6 units. They could come to Indiana and 1031 that for 30 units and
yeah,
upgrade their possibility and, the acceleration scale there. And it is really important, I think, to be able to know that, you've built it. So your CapEx should be basically none, at least for a while, other than tenant issues.
exactly. Yeah, with the new developments, I really see them as just being easier to manage, less repair and maintenance issues. Typically, like these newer properties, especially the Class A, more luxury properties, are attracting higher quality tenants. So you have a lot of busy professionals, younger couples renting these properties. So less headache on that side as well.
Yeah, and how has your rent scale been over the last year or so? Because in a lot of parts of America, rents are going down, but I'm not so sure they are in Indianapolis. Are they? Or are they staying steady, or what's going on with rents there? Because if you're building a lot, obviously you have to watch that. But one of the perks of being the builder is you kind of know your numbers, so you can take it. Well, we have 50 units. We could rent a little bit under market, fill it up, and it's still a great buy for the next person.
Yeah. So at least like here in Indianapolis, rents have been very steady even these past couple of years. There was a market report that came out not too long ago, a couple months ago, and it showed Indianapolis was one of the handfuls of cities in the entire country that's still achieving positive rent growth. Like you mentioned, there's majority of the cities out there, places in Texas, places in Florida,
Yeah.
that I think have just been like so inflated the past couple of years. Like they're all achieving flat or negative rent growth right now.
Yeah.
And not to say like those are bad markets, those will all still be great long term.
Yeah,
But
I
yeah,
agree.
like here in Indiana, we just don't like really have those large swings and fluctuations, and it's pretty like steady Eddie over here. So yeah, at least like as of right now, we're still achieving around 3% rent growth. And one key distinction that I think makes our underwriting, more conservative than other groups is that like we don't trend rents through construction. So we're going to start, leasing these property units up, 14, 15 months down the road after we start. In our underwriting model, we are not trending rents for these first 2 years. So we go through the construction year, we go through our lease up year, and then only like in year 3 will we start projecting rent growth. So that's how
Yeah.
it's been our last 2 projects. Indianapolis is still steady, but we're still, just trying to like overpromise and or underpromise and overdeliver with our projections.
Yeah. This is something I'm always interested in. Not that many people talk about it. So I always love to talk about it. When you're building these apartment complexes, what's the breakdown of bedroom, bath type units? Is it different depending on where it is? Because I think this is really important for people who want to get into development, because maybe they're not thinking right. You have to understand your market. Do you need 1 bedrooms? Do you need studios? Do you need 2 bedrooms? Do some people need a larger, bedroom count there? What works for you guys based on what you've seen so far?
Yeah, great question. So for us, we are sticking to 1 and 2 bedrooms, no studios, no 3 bedrooms. These are really like just like more modern, upscale, mixed use type projects. These are not like really projects that you see families living in or kids living in. These are, like I mentioned, the younger
Young
professionals.
pros. Yeah.
Yes, exactly. Younger couples, single people. These are really not typically people that have kids or families yet. So we stick to 1 and 2 bedrooms, and generally like more like around 65. I'd say between 65 and 75% of those units are 1 bedrooms. The rest are 2.
Yeah, it makes a lot of sense because if you just think about the price points for single family in Indianapolis, they're pretty good. Like it's really affordable compared to the rest of America. So the most of the people that you're putting in are choosing to rent. Not all of them, but a lot of them are choosing like, hey, we don't need to buy a house yet. It's just us, or I'm single. So that really makes sense now on the bedroom bath count. They're prepping for home ownership. They stay there, they get pregnant, they go buy a house. But you can buy a house in Indianapolis. There's other parts where I am. You can't buy a house. You have to shell out, $750,000 for a 3 bedroom. So that's not doable. Is that part of what you think? It's like young pros, they're going to get in, they're going to eventually figure out what they want to do. They're going to meet someone, they'll move out when they're ready.
Somewhat. These are people that are, kind of renting more just by choice, people that don't
Yeah.
have to rent. But like you mentioned, it is actually, cheaper to rent right now.
Yeah.
So for a lot of these, younger professionals, younger couples who really don't want to buy a house right now, renting makes a lot of sense for them, like in this stage of life.
Yeah. I mean, I think it's going to stay that way for a while. I think that,
Agree.
from everything that I'm looking at, I think people are just going to make smarter decisions. Maybe they rent a really high end place that you've built and then they get an investment property, maybe not for 44K, but I see that as something happening more where people are going to do that rent by choice because, hey, I can get a much better rental than I can get a house that needs work for the same, monthly payment. So it's just going to make sense. I think that's what we're going to be looking at, and you're going to see that a lot. You may have someone who's renting and they have a couple investment properties.
Good point.
It just seems like, and especially this is what I'm thinking for syndications too. The same people maybe think like, well, I have a really good job. I like this rental apartment because it's great. It has amenities. It's close to all the things that I want. Maybe I don't want to do the due diligence. Maybe I don't want to do what you did and even buy a turnkey. I just like to dunk money into an area that I like and watch it make money.
Yeah, exactly.
For the people who are investing with you guys, obviously they don't need their money right away, but what's your ideal avatar for somebody coming to you guys to invest in a syndication other than the fact that they don't need returns right away?
Yeah, these are really just, higher net worth individuals, busy professionals, people that are, working full time, but just want to sort of diversify into like more tangible assets, get away from stocks and things like that, and, invest more of their money in like real, longer term tangible assets.
Yeah. I mean, if you go back to your story, you said like, hey, we're going to try out day trading a little bit. That sucks. But it's
yeah.
interesting. Like I like stocks. I like to leave a bunch of money in index funds, but similar to index funds, I'm starting to look at syndications as another passive way. But I personally like syndications on this front and not funds right now because I like to be involved with, these 52 units. I think that investors do get say they want to invest in a city like Indianapolis, they live in California, but they don't really want to do, like we were saying in the beginning, get 6 turnkeys so they can invest in your project, feel like they're a part of, revitalizing an area in Indianapolis, but they don't really have to go on site or do anything.
Yeah, exactly. And like the best part about this structure is that you don't have to be a real estate expert to invest in real estate. You don't have to be a syndicator.
Yeah.
You don't have to be a developer. You don't have to manage contractors. You don't have to pick out paint colors. You can invest with a real estate expert and still be a real partner in the deal, own real equity in the deal, and get all the benefits from real estate without really like just lifting a finger.
Yeah. And from your guys' point of view, I mean, I've definitely talked about this with other people. It is important for you to pick and choose who invests. It's not just the people who have money because they really have to understand that they're not going to have any input. They're a limited partner, meaning basically silent. And some people really don't want that. So as a syndicator, you kind of have to go through when you're on those calls. And some people just might not be a good fit, right? If they're thinking they want to have more access to making decisions.
An active decision-making role in the project. But, if you're looking to be a limited partner, you should expect that or want that. I mean, you should want to be a, hands-off investor into a larger project. So I think like most people or a lot of people, like the ultimate goal is to be a full-time passive investor. I mean, it's a lot of work to do these projects, to do these developments. It is not passive on our side, but for the limited partner or the passive investor, it really only requires work upfront when you're figuring out who to invest with, what deal to invest in, and doing your homework upfront. After that, I mean, it's pretty much like the most passive investment that you can get.
Yeah, what's the most units that you've developed so far?
84. We're starting the 114 units in February, but 84 today.
Yeah, I mean, like you said, these are really smart numbers when you look at your outbuyer because there's going to be very targeted buyers for those. I think that makes sense. Again, when you're in at 200, of course, hedge funds can come in, but then you really have to have it like operationally perfect for them because they don't want to do anything to buy. Who have you been selling these to? Was I correct? Is it going to be some 1031 exchange, more local, bigger investors?
Well, yeah, we have one that we're looking to sell in 2025. So maybe I can come back on your show and let you know that back then.
Yeah. Yeah. Well, it's interesting, though, because I think what we found, especially from what you've been saying, is you really need to understand all parts of the business, who's going to be your investors, who you're selling to, who your avatar renter is, because that was really important content about the bedroom setup. Because, yeah, I always think about it in a way where, like, I guess generally I was thinking, well, it's good if you have a large spread of ones, a twos, a threes, and fours, but that doesn't make sense for what you were doing. And so what you said really resonated with me a lot. So all of your developments are they cap out at 2 bedrooms.
Right.
Yeah. Again, though, that you really have a tight buy and build box, which I think is really important for others to note. Whether you're looking to do large scale development or you're buying, the tighter the buy box you have, the less options you'll have. But as you were saying, when you were doing mailers, the best thing is that when that person calls, it's a good call.
I mean, I just love consistency. If it's not broken, then you have no reason to fix it. So if what worked on our past project worked really well, we have no reason to try and reinvent the wheel or take more risk or bring in more guesswork into our next project. We want to take what worked and what didn't work, leave those out, and bring those qualities into our next project. So I think the more consistent you can be, the better off you'll be with your projects and just more streamlined.
Yeah, and so how does someone with you only had you had bought 6 around a handful of single families, but how do you go to development for the first time? Because development's a whole different story. When you guys went to develop your first thing, how did you really learn the construction aspects? Because that's different than understanding the underwriting.
So we have a third-party construction company that actually does the work on the property. But for me, I've just always been like a big fan of like partnering with people who actually have more experience in the area than you. So I was wanting to, stop buying existing properties, stop buying like the whole value add business plan stuff and move into development. So I found a developer who was already experienced in development, and it made sense for us to partner on a project. So we both signed on a loan, both raised capital, are both overseeing the construction process. So it allows us to both, benefit from each other's strengths, but also for me to gain experience in that sort of field as well.
Yeah, that's so smart. And I have actually boiled that back for someone who just wants to do their first flip. I don't recommend it right now, but if you're going to do it, doing exactly what you just said, you can do on just one single family flip. You partner with someone who's done a lot more flips and you just split it. You go in 50-50, you're going to participate however you hire the person. That's a much safer way to do it. Like you're saying, you're going to do if you do your first development project and you've never development, there's going to be all sorts of entitlement issues and permitting things that you're not going to know about. And your expectation of, we'll be done with this in 14 months will be like 4 years, right?
Yeah, I agree.
Yeah. And that, again, that's another thing on under promising, over delivering. You have to be correct on your timelines, pretty close on your projections. And then I think, just from my experience on the LPN, the more transparent, the better. If the numbers are not as they were expected right away, it's great to just get that out and say how you're going to solve it, and that it's a longer tail there.
Great. I mean, telling investors the good, the bad, the ugly, keeping them informed every step of the way. If I was an investor in a project, I would want that same thing in return.
Yeah. Awesome. Well, Justin, is the best place for people to find out about what you guys do and the deals that you have going at goodindevelopment.com?
That's correct. Yeah. If you go to goodindevelopment.com, actually at goodindevelopment.com/course, I have a free 7-day email course that'll tell you, step by step how to get passively investing the right way, things to look out for, red flags to spot, all in a free 7-day course if you want to check that out too.
Yeah, awesome. And then I always usually ask for people who are going to invest in syndications, but for somebody who wants to start this, they say they have some single family experience, they bought some multis, but they want to get into something bigger. What do you think are a couple tips that you would tell them to get ready to go bigger, whether it is buying existing multifamilies or doing development? What are a couple tips that you could give them for that transition from smaller to much bigger?
I think the main thing is you need to put yourself around people who are doing what you want to do. So that first partner that I found for my first commercial multifamily deal, I met him at a local meetup. So I would have never met him or had that opportunity to partner with a guy like that if I wasn't out there, calling people, meeting people for coffee, taking people out to lunch, attending local meetups. I want to be around people who are doing those sort of things. So aside from networking, meeting people, you can do, a really beneficial job of learning this stuff. If you're listening to podcasts like this, starting your own meetup so you meet people, or, just taking courses, watching YouTube videos. But there's so much information out there nowadays, it shouldn't be hard to find more information about how to get started with this stuff.
Yeah, I completely agree. It's great advice. The meetups are where it's at, especially because you can take all the information that you have in podcasts and books because you still don't know if it's real if you're not doing those deals yet, and then find the people. I think people think, oh, I'd never find an apartment partner at a meetup. They think it's all just like, single family home buyers, but of course it's not. I've said for years, and we run meetups every month, that it's always the people that you wouldn't suspect that own the most units and have done the most deals, because that's what real estate investors do. Most of the real estate investors aren't spending their time making TikTok videos. They're just buying more apartment complexes.
I'd agree with that.
Yeah. Yeah, and I love the advice. If you don't have a meetup in your area, just start one. Maybe 2 people come the first time, maybe 3 people the next time. But if you keep doing it every month, you'll end up with a lot of people, and then you become the hub for other people to do that.
Agree. Yeah. Really powerful way to get your name out there, get your brand out there, meet new people.
Yeah. Awesome. Well, I really appreciate you spending the time. And they can get in touch with you personally through the website, right? At Goodin, that's Goodin development.com.
Correct. Yeah, either the website or even on LinkedIn, Justin Goodin, either there on Facebook, you can connect me as well.
Yeah. Awesome. Well, I'm glad that we got connected. Glad we got out another multifamily syndication, and always with a new twist. It's great to hear how people got into it and that you're into development, because I think it's a smart play. You really know your market, and I'm glad we got this in there.
Yeah. Thanks for having me on, Jonathan.
Yeah, I appreciate it. All right. That was Justin Goodin, the founder of Goodin Development. You can find him at goodindevelopment.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on the next episode. And this is who, plural, on the next episode of Zen and the Art of Real Estate Investing. It's Terry Kerr and Liz Nowlin of Mid-South Home Buyers. Now, this is a different turnkey operation. It's one thing that I had never seen before, and why I'm so excited, which you'll hear on the podcast. Now, they're so vertically integrated with property management and with the entire warehousing and construction. You're going to be amazed. Next episode. See you there.